Hello, YouTube. The Serious Brothers are back at it. Again, we are going to be going over a topic that Andrew's going to be talking about at the IMN conference. It is just go to www.imn.org. Go to the Single Family West Forum, and Andrew's going to be doing a panel there. And Andrew, what are you going to be talking about?
$4.95, and you get access to all the panels.
Yeah.
It's virtual this time because of this pandemic thing. You may have heard of it, COVID or something.
I don't know what it is.
Yeah, at 11:40 a.m. we are talking about alternative single-family portfolio
on the second
evaluations.
or the third?
The third.
The third, okay.
So Thursday the 3rd, 11:40 a.m.
So check out me in the morning.
Eastern Standard Time.
9:45 a.m. in the morning, and then you.
11:40 a.m. It's the late morning, ish. Anyways, so I mean, alternative single-family portfolio valuation methods. It really boils down. Whenever you're evaluating a single-family property by itself, it's always you're looking for the equity. Like, what is it worth? Now, if you're going to be renting it out, you also want to look at the cash flow potential of it. You want to see what do you think will cash flow with reasonable assumptions? What is the cash on cash given what kind of debt you want to use? And the simple way to look at it is the rent to cost ratio. How much is the rent for per month? Say $1,000. How much is it worth? $100,000. Or how much you buy it for?
Very useful shorthand.
1,000 divided by 100,000, 1%. If it's at 1% or more, it generally cash flows. There's this 2% rule. It's absolute trash. We'll do a video about it, just tearing it to pieces because it's garbage and it sucks and I hate it. But 1%, if it's more than that, it will generally cash flow. Sometimes if it's if it's less than that, that doesn't mean it won't. But
it depends on your financing, all sorts of things.
Now, the big shots, the hedge fund managers, the REIT managers, those guys, the guys who wear the suits and ties, they don't talk about cash. They don't talk about rent to cost. They talk about gross yield. Very different. Instead of taking the rental income for a month and divided by the total price, you take the total price and divide by the rental income for the year. So it's the same kind of thing. So it would be like, let's take the same example, 100,000 divided by 12,000, because
for the year.
Yeah, for the year, 1,000 for 12 months. That's 12% gross yield, and they're usually aiming for something like 9 to 10% gross yield. That's what I've usually seen. And I think that's all well and good. You do want to make sure that a property is going to cash flow. Houses are harder to cash flow than apartments.
Yield is just a different way to measure
especially,
cash flow.
Generally with houses, you're looking for, whether you're looking for houses individually or portfolios. If you're renting them out, you're looking for working class to middle class. If you go above that, you're competing with way too many homeowners. They don't care about its cash flow potential. It drives the price up. There's more demand, and so it's very hard to get those to cash flow. If you go too far down, you've got to be a specialist because you can easily rehab out all of your equity, and the operating costs generally are more than the operating income.
Yes.
So the best place to be is in that lower middle of the market, rental-wise, especially with houses. With apartments, you have more flexibility. With houses, especially in that area. And I think cash flow is critical. If you're going to be buying and holding, you need to cash flow. If you don't, you're kind of speculating. Yeah. It might be good speculating. Like, you have a lot of good reasons to think this area is going to improve. There's looking at the
path of progress. And
the economic plan of
There's
the
also
city.
Pseudo cash flowing, where you're not cash flowing, but you're have an income because you're making principal pay down.
So if you have long-term debt, basically, you're losing money each month, but you're paying more principal down than you're losing.
So you're making a profit, but you're losing cash.
Yeah, and you can't do that forever without refinancing. It's a little speculative. There are good reasons. If you're buying, I would not ever put a large percentage of your portfolio into that kind of thing. Maybe a small percent, because it's more risky. So you want it to cash flow, so you're not basically doing a Ponzi scheme. But in real estate, the big advantage is building up equity. That's why it's look at our ideal video. Our why buy and hold is so powerful. It's right down there. It's in this little area right beneath us, kind of where my hands are right now. It is, the big advantage is that you're paying down principal each month. Your property is appreciating each month, and when you have leverage, it's doing so exponentially. If you have an 80% loan, that means every time your property goes up 1%, it's actually going up 5% for you, because you have 5 times as much money. The property's worth 5 times as much as you have into it. Yeah. Now it could go down, two-edged sword, but if you get a good deal, then you're insulated from it going down.
That equity that you went in the beginning protects you from that.
Built-in equity. So the big question, to equity or to yield? This is the question. It is the question, and yield is important, but I am strongly of the opinion that equity is the big thing. You want equity. You want built-in equity up front, and then over the long term, you're going to build equity through principal paydown and through market appreciation, which is an up and down type of thing, but generally, most places over the long term will go up. Which means if you're looking at a portfolio, you can't just look at its operating history.
Yeah.
I mean, you do want, like, if you're a hedge fund, yeah, okay, you're just looking for a particular return for your clients. You know, you need to
But we have a huge hedge fund audience. I know that.
I know.
So.
All the hedge fund managers watch the Serious
Yeah.
Brothers. They religiously.
Yeah.
It's a little weird. It's kind of creepy, actually. It's a little cultish. We didn't even mean
But
that.
for those of you who are not hedge
the
fund
the very few of you watching this who don't manage a hedge fund, generally, yeah. I mean, you know, they're looking for their cash. Hedge, you know, the insurance companies, hedge funds, bank. You know, they're looking for a certain margin to make up for to put their money in, so they can cover their losses on it for insurance companies or meet the demands of their clients. And it's just mostly like we're trying to hit these numbers, stay in this range.
Yeah.
It's more of an institutional type of investing.
Yes, it is.
But most people who are investing like us are entrepreneurial type investing, and we're looking for that built-in equity.
Yeah.
So yes, you do want to look at, if you have a performing portfolio, you want to look at the operating history. That's critical. If you don't have a performing portfolio, it will be a challenge. We've done those before. They take a while to get going. Make sure to build in plenty of contingencies. Don't just throw in like, oh yeah, I'll be this much rehab. It's probably your portfolio is probably gonna bleed for a while.
That and the holding cost, which is gonna eat away your equity. Yeah.
But you want to perform that out. But I recommend go through each property and figure out what you think the values are. Now, okay, if you just get a portfolio sent to you, that might be too much work if you're getting a bunch of them. One quick shorthand is just get the Zestimates and just put all the Zestimates in there. Or have a virtual assistant do it for you.
That way you can see if it's worth your time.
Yeah.
A little bit, you know.
Don't trust the Zestimates. They're not 100%, but they're usually not off by more like 10%.
It gives you the target, and then you got to zoom in on the bullseye. But if it's off the board,
yeah, you can just throw a low ball, be like, I'm not going higher than this. Then once you kind of got that, you can kind of nail it down. If it's a ton of properties, you can look at just a few of them and like comp them on the MLS, which you can need a real estate license to get access to, or use Zillow or Trulia to find comps.
If you have an agent do it for you, I mean, if you have a good relationship with an agent.
Or PropStream, and go through them and do a quick evaluation on your own. This is just a shorthand. Now, if you've got it under contract, yeah, you should do a long, deep dive into each property, even if there's 100 of them.
Yes.
You want, because, our best deals, our portfolio deals, it's like you should be getting a quantity discount. Like, they're selling it in bulk. Like, you go to Costco, you want it for less than if you go to Safeway. And I demand the same with my real estate. I demand it. And so it's like you should be getting it. And also just as real estate investors, as entrepreneurial real estate investors, we want to get...
I've heard, I have no idea, but I've heard you should be expecting about like 92, 93% ARV of the kind of the bulk discount.
Yeah, that's standard. We want to beat that.
Yeah.
We want to beat that. We're still aiming to burn.
That's like if you're selling a big portfolio at market, you should expect 92, 93% of the value to be sold as.
Now, I've heard of some more programs coming on. Actually, one of the guys on the panel with Radian is creating a system that will automatically value properties based on like some rehab estimates. I'm not sure exactly how it works. I can't speak for it. I've never seen it. It hasn't even released yet. But there are programs like that you can look into. I would say at this point, I wouldn't trust them any more personally than I would the Zestimate or the Redfin estimate or the Trulia estimate. Those are shorthand ballparks. I've dug into it. Zillow likes to brag that they're like within 2 or 3% of the sales price on average, but first of all, it's a lot different if you're looking in a cookie cutter neighborhood than if you're looking in like rural areas where it's wildly different. But also, I know they do this. I've seen it. The price is here, and then it jumps up to here
as soon as
when it gets listed.
Yep.
So they're leeching off of real estate agents. Doing their comparative market analysis and putting in the property so that they go in line with the list price, and usually, especially in a hot market like we are today, the sale price is generally close to the list price. It wasn't that way 10 years ago, right after the financial crisis in 2008, but it is now. But yeah, I think the two major ways of valuing portfolios is the gross yields. We need to hit this percentage, which is really the institutional way to do it, and then the first equity, what's it worth? Then gross yield, make sure that it cash flows, $100 a door at least. That's kind of what we're aiming for. And I think that's the way you want to do it. Start with this estimate to make sure you're in the ballpark, or if you just got, the areas, you go with your gut, it feels like it's approximately this. And then start to break it down. And it's really good to get the pictures. You don't want to go through every property up front. You do eventually when you're under contract. But get the pictures, get an idea for what condition it is in. You should be able to get a gut, like that's in good condition. It will be a small turnover, a couple $1,000. This one, okay, there's definitely work here, $20,000. Get approximates for that. You're just kind of getting your feel for it. then you can make your offer based on, you know, then once you figure out approximately where you are, you can, and if you're close, you can start to really boil in. And I like to, you know, like when we kind of got an idea, we make our lower offer, and if we figure out if we're in the ballpark, then we hone in closer. It depends on how competitive the deal is, and whether or not it's like, okay, we know it's a good deal, we're gonna go after it right now, or whether it's still kind of like, you know, I'll shoot an offer out there. Like we had one that we were really close on, KCK.
Oh man.
Yeah, 21 houses.
That's one of those ones
it hurts. And that one, I knew we were close, and so I immediately started comping them, like really, really tight. Another one, there was the one you did, 19 houses?
19 houses.
We missed on that one too, but that one was like, we used the Zestman.
We went about at
did a quick one
and max level there.
Yeah, and we weren't there, and so we didn't go a little bit deeper. So it just depends, but I always think that as an entrepreneurial investor, which I'm sure, contrary to what we said earlier, the majority of the people watching this are, you want to think in terms of equity first, yield second.
You can't forget
institutions are the other way around.
Yeah, you gotta, you know, you want to invest with equity in mind to insulate yourself, to make sure you have, you know, you basically created wealth the moment you close, but you can't neglect the cash flow or the yield side of things.
No, you can't, and it insulates you from risk as well.
Yeah.
And what insulates you from risk the most is when you press that subscribe button, because then you can get all of our wisdom just shot to you on a consistent weekly basis. So they're YouTube algorithm.
And press the like button, then more people will do it and
comment about how wonderful we are.
Well, if you do have questions,
soothe our fragile self-esteem.
Submit a comment. We'll try to get to your comments, answer questions, or maybe make videos about your comments. If you want us to answer some questions directly about this topic, go to the imn.org website and sign up for the conference. Again, I have one on kind of scaling your business to 50 to 100 units. Andrew's talking
both
about
on what we just talked about. So both on December 3rd.
9:45 in the morning Eastern time.
11:40 Eastern time AM. See you guys there virtually, and have a good one.
See you guys next time.